Your 20s are loud with new money and new choices. A raise can feel like a ticket to upgrade your life fast, but that upgrade can quietly hollow out your future. This is video number 50 in the series on money habits. It will show a stubborn, simple plan to keep your money honest and still grow. We're calling it the inflation shield, a practical way to keep your core costs from inflating with your income. It's not glamorous, but it changes what your 30s look like financially. First, you need a baseline budget you never inflate. You can call it your core living budget, and it stays the same unless real costs rise. Track every dollar for a couple of months and separate what you cannot live without from what you could do without. This clarity is where your real power starts. Once you have the baseline, set up 3 connected accounts: core, growth, and joy. The idea is simple. Core pays for essentials, growth builds wealth, and joy keeps you sane. Automate everything, so you don't rely on willpower alone. Your salary should be split into those 3 accounts before you ever touch it. Joy has a cap that you decide in advance, so instant upgrades don't creep into your life. If you hit the cap, the rest of the raise goes into growth. Core remains steady unless a real cost increase forces it to grow. If rent or groceries go up, you adjust core by exactly that amount. Look at every raise or windfall as a test of discipline. If there is no real inflation in your essentials, direct the majority to growth and a smaller portion to joy. A straightforward rule you can live with is this: grow first, then enjoy, and only touch core when you must. That order makes your future smoother. If essentials did rise, adjust core accordingly, then use the remaining raise as you planned. The split remains the same for growth and joy. Now, the mechanics. Open core, growth, and joy bank accounts or envelopes, and set automated transfers on payday. Automation removes the friction that trips your discipline. Core gets a fixed monthly amount that covers rent, utilities, groceries, transport, and small recurring bills. Growth gets the remainder that you want to compound for decades. Joy gets a capped amount for treats, meals out, hobbies, or gear you actually enjoy. The cap keeps you from chasing the newest thing when you could be investing. With this setup, you can accept raises without losing your head. The majority of the extra money fuels your future, not your mirrors. Let's put numbers on it with a simple example. Suppose you earn $3,000 a month and your core is $1,800. If you get a $300 raise and essentials stay flat, allocate 60% of that raise to growth and 40% to joy, while core stays at $1,800. If essentials rise by 50, you increase core to $1,150. The remaining raise is $250, which you split 60% to growth, $150, and 40% to joy, $100, with joy still under its cap. Over time, you'll see more money and growth compounding, while joy stays controlled and core only ticks up when needed. Why this works is simple. Your 20s are a marathon, not a sprint, and the habit of saving grows quietly in the background. Automation keeps you from slipping into temptation, and a transparent baseline prevents spirals of lifestyle inflation. Investing decisions should be low-cost and diversified. Start with broad index funds and a tax-advantaged account. If your employer offers a match, take it first and maximize it, then add more to growth through a personal retirement account. Avoid market timing and high fees. Stay consistent, because time in the market beats timing the market. Build wealth-building habits, monthly reviews, quarterly rebalances, and yearly budget resets, all anchored by your baseline. The price tag journal helps you resist upgrades that don't pay you back. Before you buy, write the price and breathe. Run a small experiment. 1 month, try living within your joy cap and see how much you can save for growth. Another idea is to bring in a side project or freelance work that fits your life, so your wealth grows even if your job stays the same. In your 20s, the pressure to upgrade can feel loud. Your real power is choosing a steady path that grants options later. This plan is repeatable. Baseline, 3 accounts, a raise rule, automation, and disciplined investing. Start today with a practical step. Write down your baseline budget, then open core, growth, and joy accounts and set up automatic transfers. In the following months, watch your savings grow and your confidence rise because you aren't chasing the next upgrade every time you get paid. If you want a deeper dive, I will share a worksheet to help you calculate core, growth, and joy caps and how to adjust them. If this resonates, tell me in the comments which part you'll start with and what raise you're planning next. If you found this helpful, please like this video, subscribe for more practical wealth-building talks, and drop a comment about which part you'll start with.